3 p.m. on the 14th of April. Markets are up a little bit today. We had a nice gap higher, pull back to fill the gap. Nice little support zone. We still have a couple gaps to play around with. Want to use this little headline. I think just kind of making sense of everything last week. Fortunate enough to get some good trades rolling last week. Had some good gains. Saw some P&L. Which certainly helped battleproof and give me some more cash to work with this year. Still playing a lot of defense, but I think after the dust settled on Wednesday, Thursday, Friday, the U.S. bond market is really showing signs of strain. I would even argue that that's maybe the thing that breaks. I think everyone's wondering, what about gold? And I'm personally a big believer that gold is going to have a technical correction this year. We're at 384 bars according to my count from the 200-day moving average. We're at 16.5 to 17% from that 200 moving average. This is the exact same technical setup that I was short the S&P, short the Nasdaq, short Nvidia, short Netflix, short Meta, short Costco, short Walmart, short Palantir, short Carvana. All these reasons I was short and having hedges in the markets this year, having bear plays and topping patterns in the market this year. Same thing is happening on gold. Now, I do not want to call the top on gold, but I'm saying I'm just waiting patiently for something to give me a dip to buy on gold. So I want to talk about that today in addition to the bond market. U.S. Treasuries are up, and they're actually higher than when this whole Liberation Day tariff war started. Trade war started. This 90-day window gave the market a little bit of a breath, but it's not done yet. What looks to be somewhat encouraging is now possibly being categorized into national security. If we're going to do, semiconductors, chips, anything for phones, if we're taking it from one bucket to the next, there's still tariffs. We're looking at tariffing pharmaceuticals. We have Johnson & Johnson with earnings this week. It's like we're not done. This market is not done. There's no certainty to make new highs. There's no certainty to make new lows. I think there was a lot of manipulation going on last week. But unfortunately, even for the traders that thought, well, this is easy, I can just follow Trump on Truth Social and follow his tweets. It was a one-day move. You had a one-day move on Wednesday, and that was one of the biggest moves we've seen point-wise. One of the largest in the Nasdaq since I think the second all-time, or maybe the largest on Nasdaq all-time. One of the single largest moves on the Dow. One of the top three, I think, in the S&P for points. We had tons of market cap getting thrown around. Markets were, 85, 86% advancing. So it was just a wild Wednesday. And then Thursday, Friday, the market just kind of settled in, didn't really do a lot of damage. We had a pullback on Thursday, but based in. We had a little bit of an elevated move on Friday, but still not above the highs from Wednesday. So here's where we're at. Okay, let me zoom out for just a second. The VIX is retreating, which is kind of nice to see for the first time in several days. This peaked out on the 7th of April. The VIX is now down about 50% or so. It's down about 50% on the nose. It'd be nice to see the VIX continue to revert. I look at something between 4 and 14 days of reverting, and I believe this is now like day 5 or 6. So after this peak, 1, 2, 3, 4, 5, we're on 6 days of trading. If the volatility index can settle back into the, let's say, mid-20s, low 20s, that might allow the market to rally a little bit higher. I don't think this is done. I think that the way this market's going to kind of organize the next stages will be we had Mag 7 rotation, kind of done. After that, we had tariff tantrum, kind of done. After that, you had a bond market. Excuse me. You had a bond market tantrum. Done. But I'm going to put an asterisk next to that because now this is something I think the market has to pay closer attention to. We're coming into a seasonally bull market or a seasonal bull market. So April, May, June, July is historically a very, very bullish time for the markets. So does that allow the market to, contain the lows, maybe drift up a little bit higher, do some additional rebalancing? Maybe we get back to equilibrium around this same period as the 200 moving average. So this like 56, 5,700 zone on the S&P, 55 to 5,700 is what I've been talking about as we started this rally on Wednesday. So we have a seasonal bull market that is, underway, and I'll put an asterisk next to that because there obviously is no guarantee. We have broken correlations, right? The U.S. was down systemically 2 weeks ago, and the whole world felt it. US is down, 87% of stocks declining. China's down, Europe's down, UK is down, Australia is down. Currencies were moving all over the place with massive moves. We had flash crashes in currencies. We had crazy amounts of volatility. Like we saw like 400 to 600 pip moves on some of the majors and crosses between primaries and secondaries. Broken correlations. Bond markets moving all over the place. Yields are broken. We're worse off than we were pre-Liberation Day. Gold is still up. We made 3 days movements to get to all-time high in gold. The dollar index is still broken. The 100 handle, the DXY is below the 100 handle. We are oversold on the DXY. We're overbought on the euro dollar. I do wonder if there's a technical trade there. Can we actually short or fade the euro dollar in the near term? Can we look for DXY to pull back a little bit? And then are we going to continue to see pressure mounting on dollar weakness? What else? We still have earnings season. Earnings season is underway. Okay. Now, the guidance on earnings is probably not going to be too peachy and rosy and, rainbow and butterflies. It's probably not going to be. Granted, this rally has kind of helped save things and kind of compartmentalize tariffs to what companies and countries have to do to come to terms with whatever the next 90 days looks like. If you're trying to improve your future guidance, action's going to have to be taken now before these tariffs really take full effect. It's still like 5 times more than what it would have been if we did no tariffs, right? And we're still doing retaliation with China. Does that continue to escalate? Maybe. But earnings season is likely going to lead to, I'll put a little hyphen here, earnings season is going to likely be lower valuations, right? And that will ultimately still drive stock prices lower. You can't have an index trading at a 21 times multiple if you're going to see lower valuations, which fair market value on historical averages is around 17. So if our price to earnings multiple for the S&P is still at 20 to 21, and we're going to see this estimated lower valued lower at like 16, 15, 16, 17, that's still revisiting lows. And I believe this was around 19 times earning when the S&P was around 49 to 4,800. So I've done some rough calculations, but based on current valuations of the S&P, the price to earnings at an average of around 17 or 16 brings us down to like 4,250, brings us down to potentially 4,000. Now that's scary because we're talking about a 30, 35, 40% correction, right? So the lower valuations, I really think it depends on how steep and how ugly and how violent these valuations come in lower. If we have banks that are still looking good on the balance sheet, looking good fundamentally, there's obviously like a wait and see that the market might be able to discount and say, look, we understand the uncertainty, but fundamentally companies are still strong on the balance sheet. They still have some type of guidance of like, look, we'll get through this, we'll navigate this, or they're trying to position their businesses. And this is any business right now. I'm kind of generally speaking here, but position yourself for fundamental strength in the coming years. You're looking for like non-tariff related exposure. I think right now in the US, that non-tariff related exposure is probably going to be parked more in utilities and probably parked more in financials. They have the least amount of exposure for any sector, right? If you're in the tech sector, even if we're rotating with like, it sounds like Trump's trying to navigate things for national security, but it won't affect, all the exposure that companies have to China. That could be like a one-off exception, but they're not exempt. So there's still tariffs. Pharmaceuticals. Well, I thought healthcare was going to be fairly exempt, but they're not because we might just tariff pharmaceuticals, right? So all these things are happening, and this is why we're not done yet. And I'm not here to say this is doom and gloom. I'm really not. Okay. But I am saying that based on the lineup here, if I just sequence this year from 2025, this is what we knew had to happen. Mag 7 rotation had to happen, and it did. I think that's what led us to the first real correction of 7-8%. The tariff tantrum thrown on top of that accelerated the move a little bit more, created the uncertainty, and of course, Liberation Day and everything on top of it goes hand in hand with a bigger fear. I mean, we are seeing some of the sentiment readings as low as they have ever been. And we're talking about sentiment readings that are as bad as like legitimate bear markets, as bad as crises that we've seen over the last 25, 30 years. And I've said this now for months. Sentiment is not a signal. Okay. But as we, hammer these lows, we had some good technical corrections back to about 20% of the S&P. It came right back to previous all-time highs back in that high in January 2022, right around that 4,800 handle. Technically, it was very impressive that it went straight down in those 3 days and then bottomed hard. Okay. So we are, well off the lows. I mean, the S&P is up around 600 points off the lows, which is a nice little relief. Year to date, we're not nearly as damaged. I think we're still in single digits now. I don't think we're double digits down. Let me check this year. So if I go year to date, sector, let's go year to date. So S&P is down 8.81% year to date, as opposed to this. And it's still, even from the high to low, it was around 21%. It was only reading about 13, 14% year to date, because the market had started the year up pretty high after hitting all-time highs here in December, here again early in January, here again in February. But the year started, down near this low. When we rolled into the new year, that was after FOMC disruption December 18th. We started out the year with a bit of a rally, tested that rally again, and then fell pretty hard. So a couple of ways I just see this whole thing playing out, okay? I think it's very possible that the market fights very hard in here. Meaning, if the bulls can work their prices back to 55 or 5,700, I think the bears could work it right back down. The bears might be able to work it back down to a correction level, work it all the way back down to the same lows again, right? Also, if you look back to like an 07, 08, it may be possible that this is a bit of a volatility event. Let me change that back so I can see that again. This might be a bit of a volatility event. And if the market works its way back into, I don't know how we get to all-time highs from here based on all these things lining up. I don't know how we get back to all-time highs. The only way we get back to all-time highs to me is that we put this like, this has to be fixed. We have to fix the tariff uncertainty. So what does that look like? Probably some type of negotiation with China. Something where the world's going to have to be happier about things than it is right now. So if we can fix the tariff drama, if we can fix this trade war problem, I think the market fundamentally can show some resiliency, but we still have high valuations. And if we're going to have higher valuations, we're still trading at a higher multiple, 21, 22, 23 times earnings. I don't think that's sustainable, and so I would be skeptical of getting to all-time highs unless this is a melt up. I think this bubble gets worse and worse and worse if we go to all-time highs. So, also what happens, we probably see the 10-year rally. We see this big, I keep reading about this liquidity air pocket coming in August and September. And right now, this is going to be right around the time that the Fed's looking to cut rates. Okay, so I'm just going to put some summaries out here. I mean, all this stuff is happening. Mag 7 already happened. Mag 7 was beat up really badly. It kind of balanced out through this Wednesday rip. Tariff tantrum is in, but there's a lot of uncertainty. Bond market tantrum is still happening. The yields are up, worse than where they were pre-Liberation Day. Bonds are down, starting to stabilize a little bit, but not in a good way. Seasonal bull market, this is one thing that's kind of encouraging right now in the near term. We have a lot of broken correlations. Earnings season has to look very, very good. But I can almost promise you that the guidance is going to be very, very uncertain. And more so than just earnings, like this quarter, for this next like 3-4 weeks of earnings, it's not going to be just about earnings per share and revenue. I think it's going to be about the transcripts. It's going to be about the guidance. It's going to be what they say in these earnings calls, because that will give the market the idea of who's optimistic and who's pessimistic. Uncertainty doesn't help anybody. Uncertainty could be priced in negatively. But is anybody like straight up pessimistic? Is anybody super euphoric and optimistic? I think it's going to be a very gray quarter for earnings, because nobody really has a crystal ball guidance. I mean, there's been enough damage here done in a very short amount of time. I like, personally, look, I'm just trying to play defense. I mean, if this market wants to get worse to the downside, I want to be covered. I don't want to get beat up even worse than I was. I was down at the worst case scenario here from high to low. I was down around 8% in open positions. And then back up here, I'm now like positive again. I'm positive year to date. A lot of my accounts are still hanging out around 5% year to date gains, which I'm happy with. Obviously, that's fine. It's not great. I don't want my year to be like, well, I didn't lose money this year. I mean, that's a huge win if the market is down. But if there's a way to carve out gains, despite the market being down, 8%, or despite the market be down maybe 10, 12, 15, 20%, man, any gains would be fantastic. So what else do we have? Next up, on top of all this stuff, we still have the liquidity air pocket. Okay, and that would be, refi in September to December. right? And we have yields still stubbornly high. A big sticking point to the market. Look, we were worried about inflation for the last 3-4 years and trying to trend lower and get inflation down to a 2% target. Yields not coming off that four handle, and let alone dropping below the four handle, ripping up 70 basis points now to 4.3, 4.4. Stubbornly high yields mean that the Fed's essentially rolling over debt at a higher interest rate. Companies having to refi, look for cash, get some type of cash runway at a higher interest rate. Homeowners wanting to refi had a higher interest rate, probably not going to do anything. I wanting to buy a house in the next 45 days at a higher interest rate. I'm not thrilled about closing at 6.5%. I'm certainly not thrilled at closing at high sixes either. So this is a big window. On top of that, you have an employment window. September to December, because we have Fed. I'll put federal layoffs hit data points September to December. So if everyone that's fired in the public sector has to go find jobs in the private sector and they're no longer available, or there's more layoffs, look for initial jobless claims, look for continued jobless claims, and look to see what the unemployment rate does. So right now we have a window from now until probably July 9, which July 9 is going to be your tariff tantrum. So you have July 9, right? July 9 is going to be when everything kind of resumes with tariffs. Is it worse? Is it better? Is it the same? Are the negotiations happening now until July 9? Is there even a plan? Do we have any idea? Is there a plan? I don't know. Okay. But we have a window now until July 9 to kind of stabilize. See if things fundamentally can show, okay, earnings are okay. Guidance is okay. There's probably going to be a sliver of optimism. But if we have more tariff tantrums coming, on top of that, you start to see earnings season is somewhat cloudy, somewhat gray, somewhat pessimistic. Earnings are valued lower. You're going to see this market trying to revisit lows. Liquidity air pocket and that same thing, late summer and unemployment. I mean, if the Fed is starting to cut in June, I also have a concern that every time the cuts have happened from the Fed, I know that we cut 100 basis points last fall, okay? But those cuts didn't break the market. The cuts didn't break the market. My concern is that this go around, the Fed's even cutting 25, 25, 25, 25 by the end of the year. It could be three cuts or 4 cuts, but anywhere between another 75 basis points to 100 basis points. If the yields don't cooperate with those cuts, meaning if the Fed cuts rates by 100 basis points and yields do the opposite, this market is likely going to go way lower. Because the only thing that brought the 10-year yields down was the market actually dumping 20% from high to lows, right? So there is a concern that these valuations and the Fed cutting rates into what is a slowing economy that might be validated by earnings compressions, this could all be rolling over. So I think that the look to this market might be battle royale in here, lots of indecision until maybe July 9th, maybe until into August, September, and we'll see if this market is able to overcome all the obstacles or if it gets worse. Right? Do we get worse to revisit lows? Do we get worse and actually break fresh lows? I said this before, nothing good is happening below 4,800. This chart has virtually no floor below 4,800. This is a very, very concerning spot. So if we're lucky as investors, we'd have a bear trap here that the market can bottom out and go off of. Or if we revisit this low and we break this low, there's not much stopping it. So I put bottom area if we have a bear trap. Okay. But if this market breaks, if this market is coming up here to stall, and then there's another rollover and we get to a lower low, look, high to low, lower high to lower low, even that rally to a lower low. This could look like every bit of 2000 again. This could look like every bit of 2008, where the market did not see a true sustainable bottom until we hit 40 to 55% from the tops. And that is a very scary, very painful decline in the market. So I think what is critical is I am prepared for this with hedges just in case. But if we can hold this low, good. And it's I'm trying to make it that simple. If we can't hold this low, I'm not very optimistic about what this market gives us over the coming, let's say, 6 to 12 months. But if we can hold this low, where all we do is we chop around here, volatility goes from 60 back down into the 30s, maybe goes into the 20s and kind of settles in with slightly elevated volatility, but nothing that's going to, scare the pants off investors here. Maybe this is just stuck with some indecision, and we are going to see some chop until July 9th. What happens with tariffs? We have a window with earnings. What do the transcripts say? What do the earnings calls say? What type of guidance are companies issuing? Positive, negative. And then from there, it's, the Fed's going to start cutting likely in June. That's probably the same window that they're forecasting. They're being pretty transparent. The pause is likely happening in May. I don't think the Fed should do anything like an emergency rate cut. I also think we've been talking about these put levels. The Trump put was essentially this bottom. Okay. The Fed put is probably way the heck out here at a 50% decline. That's this outer trend line. That would be, that's 50%. That level's where the Fed's going to step in and probably start slashing to, interest rates that are sub 1, low interest rates 0.75, 0.5, 0.25. It's not necessarily great for anything. It's more inflationary. This is that paper printing, money printing, fiscal cliff that just gets worse because I don't know the numbers anymore, right? $700 billion got us through the great financial crisis in 2007 and 8. $700 billion, okay? COVID was $3 or $4 trillion and the world was like $6 trillion. The world is still very much correlated and interconnected with this stuff. The fiat system is very connected. If globally central banks are trying to do things like monetary policy to right the ship and react to a bottom and try to be, helping the market provide more liquidity, my concern is that this final move, it's exponentially more money printing. From 700 billion to 6 trillion. I mean, is it 15 trillion? Is it 20 trillion? Is it another 10x leverage where we've got to have like 50, 60 trillion dollars? I have no idea. And I think at that point it's like it kind of seems like it could be game over, right? It's going to be maybe gold's the clear winner. The markets crash and crumble. Bitcoin might come out of this okay. Might. But I hope we don't have to get there. I mean, that's the thing is I know there are some people out there that are cheering this stuff on like they want the world to end. I don't think you have any idea how interconnected this entire global system is. And it's not going to be pretty. After this whole reset, if you have some Bitcoin, maybe you're fine. If you have some gold, maybe you're fine. But I think the financial markets are too big to fail. I really do. I think there are mechanisms to try to avoid or alleviate the pain of a 2008 all over again. But the problem is we have a lot of tension out there in the global economy. So this wouldn't be like every central bank steps up to the plate and says, hey, look, we're going to save the global economy by doing this, because right now it's all strained on these relationships of we have a trade war. And if we're trying to make things better, I don't think that if the global economy is failing on a liquidity crisis or a credit event, that on top of that, we have everyone come together and say, well, we'll save the market despite a trade war, because they may not, and they may not be able to. So my whole point is the Fed put, right? The Fed put would be way the heck down here. We'd have to have probably a 45, 50% decline for me to say the Fed would be looking to possibly step in. And nobody's going to like that. I mean, if this market breaks 48, you can see this chart's wide open. So I don't love it. And it's how fast it fell from 55 to 48. We could do the same thing again. It could just be falling in open space until the 2022 bottom, maybe around 3,500. If you're lucky at 4,000, there's a round number here, but still, I wouldn't take my chances in calling bottoms there. So this is why I'm really focused on how well I can hedge. I think if we're lucky for timing right now, out to May, out to June, we've got some opportunities to see some resiliency in this market. I think things slow down a little bit. I think that the intraday swings slow down a little bit. The VIX will revert slightly, but at best, I think if the S&P comes back to like 56, 5,700, and there's still no signs of negotiation from China, then this market's not gonna break much higher. If we still have a constant tit for tat retaliatory trade war, this is about as high as we get. I could see the market fighting, stalling. Eventually, if this rolls over on itself, I think we revisit the lows. So I'm still watching for levels to be trading some hedges. I think getting back a hedge into October, November, December looks good. I think even into 2026 looks fine. Even if we're at all-time highs, I would put in a hedge here. I put in a hedge here, and I would go out into December of 2025, and then I'd probably go into like summer, maybe August, September 2026, end of 2026, and just be ready for a larger bubble to take over. Because if you look back at the price action in 07, let's go back on the weekly time frame here. Let's go weekly to monthly. Let's go monthly. Let's go all the way back to 07, 08. Here's 2015, 16. I mean, we could do this. This is potentially, maybe the market does something like that, where it's just sideways for a couple of years, doesn't really do crazy amounts of damage lower, but it's about a 20% correction. I could see that taking place. It's about an 18 to 20% correction for those 2 years. Okay, you go into, it's crazy how much more volatile this market has been. That is .com, right? So .com crash up here to 2008 crash, then the market rips. But let me zoom in on, let me zoom in here. Let's take this window on a weekly chart. Let's watch how this area played out on a weekly chart. Okay, so if we are going to see a larger topping pattern, this market did fall from, getting back up. Let me see the .com highs. Here you go. So this market came right back to the .com highs, and we did it once, and we fell. We did it again, and we fell, and then the market broke out, and then there's your real crisis. Okay, it took a long. I mean, this is a horrible decade, by the way, from 2000's top into the bottoms in 09. I know the market spent its way up, but you had a 14-year decline from all-time highs. That's not a fun 14-year window for an average investor. Having essentially, nothing to show for it outside of, yes, you've been dollar cost averaging, but getting back above these all-time highs took, over a decade. That's not fun, right? But if the market puts in a bit of a low, and I'm just saying this is similar to what we're seeing price action wise now. Let's say that we put in a low here, right? And then the market finds a way to come back to middle, come back and revisit the highs again. I'm very skeptical at the new all-time highs around 6,200 on the SPX. So do we come back down to fresh lows again? If it breaks this level, I'd be looking to fade and see how bad it gets. If this is below, I'm saying this is hypothetical here, but if this is below 4,800, if we take this to current price action, if we get below 4,800, I think any rally looks like a chance to sell, and below 4,800, nothing looks good until probably 3,500 or 3,000. That's a big window for the bears to target. That is getting into like the 45 to 50% correction zones. That is as bad as we've seen in 2008. That's as bad as we saw in 2000, 2001. That's as bad as this market's been in its history. So could it happen again? Sure, it could happen again, right? But for right now, I think we have at least a couple months where the market's going to just stabilize, get its act together. And there's time to figure things out. I hope there's time to figure things out, right? But even some really basic technicals on the weekly time frame, we're right back down towards the 200 moving average. If we break below the 200 weekly, not a good sign. Bye. It's not looking good. So it really is key that this high, this low, even if it comes back and dances around in the middle and drives every trader crazy, that we don't necessarily do too much damage below 48. And even if we get back to highs again, I think this is still a range trade to deal with some uncertainty. Not enough to break the global economy, but enough to certainly make it where we can't justify going all-time highs. Okay, I don't have any trades I'm putting on right now for hedges. Not yet. Okay, hedges I'm looking at are going to be somewhere around that 56, 50, 700 zone. I don't mind it since we are 600 pips off the recent lows, but I think this market can get back up into this gap fill. Okay, so in this area, this is around the 50% zone, 61% zone, a little bit higher. So if I was looking at hedges, a couple ways to trade it would be, just an at the money spread and go after it. So if I did something on SPY and put in a spread, that's one way to do it. If I want to go some like really inexpensive hedges, I'd probably do an out of the money put spread down here where I buy a put and I sell a put and I go out of the money. This one might cost me, let's say that I do like a 10 wide here. Well, it might cost me like 50 cents to take this trade, and I've got $9.50 of reward. So it's cost effective to take the trade if this is a 50-cent debit, but I get, 20x return if I'm right. So even if I don't get the full 20x return, I could turn it into 3, 4, 5, 6 times my debit if price is going to come back and revisit the lows. So I'll talk more about that on Thursday. I've got a class on Thursday to discuss. I'm going to see if the market can kind of stay up here and melt up into this gap a little bit. Also, there is no trading on Friday. It's Good Friday. Markets are closed. So if we have a little melt up through Thursday, possibly put in on a trade starting Thursday, and then getting ready for post post holiday. Let's come back in Monday and see what the market looks like if we're in that kind of technical spot. But I think a lot of resistance is around this 200 moving average. So between 5,600, 5,700, that's a big spot in the S&P to look for some resistance. If I had a June put, I don't even like the June put, honestly. I don't think June's enough time. If you did June, here's what happens. If you do a June put and the market goes up, your June put's worthless. I would rather price in a, October, November, December in case we have a failing Q4, or by the end of the year, if the market is not higher, I'd rather have that be willing to go out a little bit further in time, offer up big reward to risk. And if the market, pulls up here at all in the next couple months for this bullish seasonality and then comes back down to revisit the low at all, it may not be a perfect trade for full profit, but you can certainly turn it into a big reward to risk if we come back and revisit lows. So we'll talk more about that on Thursday for my crash insurance masterclass. Everything else, so we're up 1.3 on the SPX today. SPY up 1.48. Mags is also pushing a little bit higher. Nasdaq up around 1.3. Dow's up 1.3. Russell up 1.5. VIX down, quite a bit. Hopefully we settle back into the low 20s, maybe even back into the teens again, which would be kind of refreshing. I'm a little bit concerned with this going higher. So this is the bond market option volatility. There's a lot of back and forth and a lot of broken price action going in the bond market, yield market. I did buy some SVXY today. I'm up a little bit. I think I bought it at 36.28. I'm up about 20 cents right now. Nothing crazy, but or it's 35.68. 35. I'm up about 80 cents right now. 80 cents a share. So I'm trying to get back in this chart alarm, make about $300 to $400 on that little hedge. Dollar index, watch out for this oversold condition. I think the dollar might also snap back a little bit. Oil, I looked at this morning. I couldn't get a fill. I couldn't even get a price that I wanted on CL. I was looking at a strangle or an iron condor on CL for oil futures. Just because we had this big shakeout from the high at 72 to the low at 55. If this market's going to kind of dance around in between, maybe put it on an iron condor here if price just stays this way for about 40 to 60 days. But I want to do it to find risk, because if something happens where this thing spikes higher, I don't want to be stuck for a futures trade that gets beat up. That makes sense? So I'm still pretty cautious on oil. We're talking about drill, baby, drill, but big energy does not make any money drilling heavily at $55 a barrel. I think for everyone to be happy, we probably have to stay around this $60 handle. We probably have to be above that, to be honest, to make everyone happy and think like we're going to keep building these projects, because it's just not that profitable. So anyway, this I was looking at on CL today. I'm still long natural gas through UNG, trading diagonal spread out to 2027. I am still looking for an opportunity to buy a dip on gold. I keep talking about this. I don't know how it happens. I really don't. But look, you can earmark all these conversations I've had in live sessions. I don't know how gold gets to the 200 moving average this year, but I'm pretty confident it's going to get there. And I want to be the first to say I'm buying gold. And it might be like everyone that sits here and watches gold crash, they're wondering why. And I'm just going to take some bites on gold and see if it's enough to get back to all-time highs. But this is 380 plus bars overextended. This is almost 17% overextended. I don't see a lot of these historically on gold. You can go back any time on gold and take a daily time frame and see that it doesn't really stretch 15, 16, 17% away from the all-time, from the 200 moving average. So we have a lot of overbought conditions with divergence. We keep making these higher highs. I looked at this morning on one of my other workspaces. We have some divergence on relative strength. We have some divergence on MACD with a signal line crossover. I have relative strength and momentum disagreeing as well. We also have money flow that is disagreeing. So these three things combined, again, I'm not shorting gold, but I think gold at the very least has to have a pullback, and I want to buy that dip. And I don't know what it's going to do that crashes gold, because if it's really abrupt, it could just be like a one-off thing. Or gold does something like this where it just gets ballistic and broken to the upside. And at that point, I'd just be trailing. You can put on like a PSAR, like the parabolic SAR. A PSAR is a good indicator. Like when price breaks that, get out of the trade. Especially if we're sitting here at these highs that have been drifting and trending so strongly. I would not be messing with, like, if it breaks lower, I think there's room to fall back to the 200 moving average. That's all the way back down towards like 2,700. We've got some gold bulls that I've talked to that are just thinking like this won't break down below 2,900, and that's fine. It broke down to like 2,960, had another 3-day run, but at least some consolidation. So anyway, that's gold. Silver's had a nice little comeback. I'm pretty happy to see this resiliency and bounce back up. Bitcoin from lows around 74.6. This is 74,600. Still hasn't broken the trend line yet. Still hasn't cleared some of this resistance around 88.5. But a little bit of time and a little bit of bullishness could possibly send Bitcoin higher. Okay. There could be some noise in here still. So not breaking highs, not breaking lows, more noise. But if we carve out a bottom here, Bitcoin hopefully looks capable of getting back to 108. Okay. BITO off the lows. IBIT, I took some profit on IBIT. I had a ratio spread, the 47. It was a 46 by 45, I believe. I closed out for profit. FBT, see nothing there. MicroStrategy still trading above 310. I might look at an income flip on the collar trade that I have. Coinbase, I needed to stay above 155 to close it out today for a 5-cent debit. So 225 per contract, close it out for a 5-cent debit, pulled in about 99% of that profit. Ethereum wouldn't touch this till we break the trend line. Copper, nice move on copper. This is actually really good. This trade should be working out for full profit by the 24th. That's a futures trade. Japanese yen still making fresh highs. Nikkei bouncing off the August 5th lows. FXY, this is Japanese yen. EWJ, back to the halfway point after this collapse. I've got a break even around $65. DXJ, that's another Japanese yen instrument. DAX showing some resiliency. I think DAX looks better. If anybody's interested in, hey, look, I'm going to buy the DAX, stop loss below, try to get back to the highs. Everyone is all excited about, this non-U.S. play where Germany's doing well, UK is doing well, Argentina, Latin America, Brazil, like everything non-U.S. was looking to crank. China was up. That was quickly reset. So I think this looks a little bit less attractive, certainly more volatile, but there is an opportunity to kind of revisit where we were for the highs of the year. Just be careful. I think there's risk in all these trades. Okay. Let's see here. COT shows positioning on CL on both large speculators commercials, which is marked previous lows. That's good to know. I mean, and it could. I just don't know if I want to trade like directionally neutral on CL, because if I trade directionally neutral but price goes higher because the bottom is in, I don't want to get stuck on the wrong side of the trade either. So I'm probably just going to stay out of oil for right now. Fez, this was an ETF that I traded to sell a bunch of premium around the 40s. FTSE responding nicely, but I still like Fez and DAX better. Argentina, right off the 200 moving average. What a nice spot there. It's up about $8 a share off the 200. China, looking better, but like a little bit of a threat. You can connect this outer trend line. It seems to still be holding for right now. So that trend line support is still holding. If you're taking some dips and stabs at China. This is Brazil. This is Latin America. Mags up a little bit. I think we gapped higher in Mags. We faded a little bit. I think this could still drift into the let's say like $48 to $50 zone. $48 to $50 zone on Mag 7. And from there, I would be looking at, if we're lucky on Mags, comes up here, settles, and Mags might get us a push and revisit all-time highs. If the S&P is going to get it back to all-time highs, I would think that Mags has to do the same. If Mags does not get all-time highs, I don't think the S&P or the Qs are going to get there either. So this is a pretty important chart to watch. If you're following some price action, being below the 200 moving average. This is a bear market right now. Apple still looking better. I think I have some trades running on Apple this week. Don't know if I closed them out yet. I might have, I might not have. I think they're still throwing some risk out there. So I have a ratio spread. Okay, this is up 93%. I didn't close these out, but I think I'm going to because I'm up 92% of the max profit. Is there a bonus trap? We're trading at 204. It's a ratio spread. I could get lucky if I want to hang on to it for Friday, but let me check here. So Apple. So this trade here pulled in $1.21 credit. It's trading for $1.10, $1.11. I'm up 92%. I think I'm just going to take the profit, get the buying power back, and let the trade continue to work. So let me close this down for a small debit. Right now, trading for about 10 cents. Just take it off the table. 10 cents. Let's go 11. $1.20 something, 12-cent debit. Come on. 13 cents debit. 13 cents debit is filled. Okay, Apple sold some puts. I'll roll that covered call. That's up $6,000. I've got a good chunk here on this one for Apple. I'm going to keep rolling it for income. This is a ratio spread out to January. Not really worried about that one, but let me label this at least. Oops. So this is a ratio spread. Okay. So January ratio spread, naked put, covered call, looking good. This account, label this one ratio. And this one for April's ratio spread, same thing. Close this one down for mostly profit. 13. Okay, closing out for the win. This trade for Apple. This one is a bull put spread. Okay, I'll leave that one alone. This one is a wide bull put and a ratio spread. This one is a ratio spread. Oops. No exposure there. This one ratio spread. This one's ratio spread. So April, close this one down. Come on. Okay, closed out for $104 a contract. 35, no exposure. Cash there, no exposure. No exposure. And bull put, that one's fine. So all I have on Apple now with all positions, I have some shares that are covered. January ratio spreads, bull put spreads out to June, naked put out to June, ratio spread into January, ratio spread into January, bull put to June, ratio, wide bull put, naked put, covered call I'll roll out to January of next year, covered call I'll roll, naked put to June, ratio spread closed out, or I'll close that one out later this year. Naked put and ratio spreads for April 17th. I'm closing. That's another winner on Apple. So closing that, adding some more buying power to the mix, taking another 3 or 4 winners for profit. Good. Amazon. I do have some trades running on Amazon. June, May, December, June. So nothing in April, but I do have some ratio spreads. We're trading at 182, and my nearest expiration would be the 150 in June, 150 in December, 175 by 180 in May. We're going to have to see some resiliency. Like this right now is down about $300. And I think there's time. If we have some resiliency and Mag 7 recovers, we're entering into a pretty bullish season. Uh, if Amazon earnings are satisfactory, I'm hoping that this can stay above 175, and hopefully post earnings we get some nice profits there. And then the rest is, so it's May, June, December for my Amazon trades. Okay, so I'll keep an eye on that one. Broadcom, no trade on that one for me. Google, I still have some exposure. I bought a bunch of shares. So 190, 176, 150, bought some shares. Income trades out to later expirations. Coinbase, I closed out today for profit. Google is here. Nibbled on some smaller shares of the 190 handle. Ratio spreads. Sold some puts. May, December, June. Yeah, May, December, June, January. So expiration's out a little bit farther. Meta, nothing yet. I'm gonna sit on that a little bit longer. Microsoft, I closed out for some winners today. So this one I closed out for profit. I still have some trades on Microsoft that should go out a little bit farther. Have some shares. And that's it. Just a dollar cost average into Microsoft. Nothing crazy there. Closed out that this one is closed. So 229 credit. Close it out for 35 cents. So took about $1.90 profit out of that per contract. So income for profit, income for profit, income for profit, some dollar cost averaging. That's all I have in Microsoft right now. Joy, they were in the tracker. You know what? I never got the reminder from Deanna today. Hang on a second. Deanna. Let me get the, oh shoot, it's almost closing bell. This is fine. You can take these trades tomorrow. Waterfall income, new trades. Let me get those posted really quickly. These were taken during the live session, Monday at 11:30 a.m. Eastern Time. The trades are still valid for Tuesday's trading day. So let me get those posted. So copy this one. So that was a 69-cent credit. Regular profit target would be, do the math on this one really quickly. Be a 35-cent debit. Okay, and then trade number 2. $0.50 credit. The math in this one. 35 debit. Okay. So trades are in. Those alerts should get posted. Sorry about that. And I get posted at noon today. They were in during the live session, but they're still good for tomorrow. They're still valid. They are still valid. All right. Netflix at 9:31 with earnings this week. I'm looking at a trade on Netflix. I don't know how big the earnings play is going to be, but for my newsbreaker service, I'll probably throw Netflix in. This is a Thursday close, so I'll look at a trade that either we take off on Friday or we take off next week. I think it depends on, I don't know if the market is super stoked about Netflix or if there's going to be like a little volatility crush. I don't know. Let me see what Netflix is doing right now. Netflix at a 64.4. Expected move would be April 17th is Thursday. Actually, you know what? I don't even think we can trade Netflix. We'd have to go out to the 25th because I want to say it's Thursday after market. Let me check. Thursday after close, so the market's closed on Friday. So if we took a trade on Thursday, like it's dumb. Like we're not going to do a trade on Thursday. So yeah, I don't want to be stuck in like a post-market earnings print. So we'd have to go out another week on Netflix and see what it does. All right. So I'll put that one. I'll put a pin in that one for this week. But I'm looking for Newsbreaker service to take a trade on Netflix. Maybe some home builders. Maybe. Just looking at the earnings calendar this week. Um, I don't know. I'm going to price in a bunch of these. I'm going to see what I get for some of my scans and filters on how good they look, how the option prices play out. It's a lot of financials, which are typically pretty boring. Last week on JPM, we made a nice sort of return. I think a lot of these trades might also do the same type of thing. As there's a lot of higher volatility movements that don't necessarily go anywhere because the guidance is wishy-washy. I don't know. Um, but I just think I need to make sure like the option prices are so good probability wise that that's the only way I'm feeling comfortable taking trades with these catalysts. Okay. U.S. businesses sue to block Trump tariffs. Lawsuit. U.S. Court of International Trade alleges that Trump was illegally usurping Congress power to levy tariffs by claiming that trade deficits with our countries constitute an emergency. That'll be interesting. Let's see, managing trades expectations. Let me try. Okay, so those are what we have for earnings this week. Market's going to close on Thursday, and there's no trading on Friday. So I'll just take that into consideration. Maybe going out 1 or 2 weeks for some of these earnings trades and see what next week gives us. How do we ask questions for you in this YouTube session, James? I can see your comment right now. Why do you put some trades as 1-1-1 and put as put ratios? Well, they're different because if I do a put ratio spread, usually a put ratio spread is buy put for one contract, sell put for two contracts. That's a ratio spread. If I do a 1-1-1, so this would be a put ratio spread. So I buy one put, sell two puts. That's a ratio spread. If I do a put condor or a 1-1-1 or 1-1-1-1, that type of trade would be I buy a put for one contract, sell a put for one contract, and then I sell another put at a lower price for one contract, and I potentially buy a put for one contract to make it define risk. So it just depends on the scenario. If my buy put, sell put right here is narrower than the sell put, buy put credit spread, this is usually wider. And so this whole trade offers a credit. And then it creates a little bit of a profit trap. So I have, if we're below this level, but we're above this level, then there's a sweet spot here for a profit trap. And I just base it on the deltas. I base it on the probability of profit. I base it on what is my, peak profit if I can get it. The bonus profit is usually the bonus profit is usually not the plan. It's just a nice little bonus if we get it. We had a bunch of trades in waterfall income that we made like 110% gains, 120% gains, 115, 20% gains because that profit trap was offered up a little bit as we got closer to expiration. Okay. They fell from 51 cents to 20 cents. They should be back up tomorrow, Joy. If you look at them today with the market falling, I mean, the market didn't really finish on a high note. So if we come into tomorrow's trading, if prices are back down where they started, I mean, we started that session today around 11:30. So right around here, if prices are down here tomorrow, then those trades should be offering up about the same. I could also look at some of the different strikes and maybe moving my strikes up, maybe one strike higher, one strike lower, and see if I can do about the same position. Okay. All right. Good stuff there. Okay. So, really quickly before we go, this is why I started today's session with bond market crisis. This isn't just clickbait. I mean, the uncertainty that we're facing is this: the 10-year yield. Liberation Day was April 2nd, correct? April 2nd after the close. April 2nd after the close was right here. There's March 28th, 31st, 1st, and 2nd. After this, so the close of this day was Liberation Day. Let me put a line here. Let's go text, flag, drawing tools. Come on. I'm looking for an arrow here. Anything? I know there's drawing tools in here somewhere. Brush, highlighter, arrow marker. There it is. Okay. So Liberation Day would be there. So there's your Liberation Day lows. Everyone got all excited that the market's getting crushed, by the way. Like this was, terrible news after Liberation Day. Market falls on the 3rd and the 4th and the 7th, and there's your big drop in the equities market. There's your big drop in the yields. This is when it's like, look, we're doing everything right. Oil's down, 10 years down, stocks have fallen, but it's going to be fine. And then the exact opposite happens when it's like, now's a good time to buy. Market rips up. It's just the bond market is like showing signs of cracking. So I think I have a tariff tracker here. The live update right now, per the numbers, is since Liberation Day, S&P is still down 5.6%. Since Liberation Day, Nasdaq down 4.8%. Small cap still down 9%. Bitcoin is up 2.7 post Liberation Day. Gold is still up 2.6. Everything else is red. Right? China's down, Japan's down, oil's down, Germany's down, UK's down, Mag 7's still down, small caps, Nasdaq. Now it's fighting back, but everything is still down except for Bitcoin and gold, which is interesting. But since Liberation Day, nothing's red. Or I'm sorry, nothing is green. Which, we're obviously a long ways away from it. But things have not gotten better despite what we're being told. And this US 10-year is a really good example of why things are not great. The bond market, and this is what happened in September. This is, they're arguing like, bond vigilantes are doing the opposite of the Fed. I know the Fed's likely going to cut 3 to 4 times this year. How does the bond market take it? Well, the worst case scenario reaction would be that the bond market says, okay, Fed, you want to cut rates, we're going to rally up exactly the same amount. So if they cut 100 basis points this year, right, if they cut 100 BPS to the downside and this goes up 100 basis points, we're talking about the 10-year yield above 5%. That's a terrible look to the market. So is that what's going to happen? I don't know. I hope not. Okay. But the only way that the 10-year got lower was because the markets were down 20% from the highs. So this has to change, and I don't know what it's going to be. I don't know if something's going to have to break before it gets better. The 20-year was another big one. The 20-year spiked up from 4.36 all the way to over 5%. I think this got the attention of the administration. This is why they probably intervened in some way to say, look, we're doing a 90-day pause. Because we were up here, 60 to 70 basis points in 3 trading days. This was like one of the biggest moves the bond market's ever seen. And TLT is down 9%, almost 10% in 3 or 4 days. Just complete backwards movement. So does this settle back in? I don't know. I don't know if they can contain it. And if assets go up, I think this goes up. If prices go down, maybe it comes back down, but we might have to revisit those lows again. And it could be a very delicate situation for the entire market between US equities, US bonds. But it's going to be tough to navigate. Okay, how do we get a replay on YouTube? This will be available in my YouTube channel. It's pretty easy. Go to youtube.com/Chris Pulver. And once this thing is done with the live session, so we're live right here. When it's done, just go into live and you'll see the actual archive recording right here. It'll say, hours ago, whatever, and that's it. So usually I get this about, 30, 40, 50 people watching live, and then afterwards I get 3, 4, 500 views. So that's about right. I do it at the same time every single day, or I post a video to release at the same time every day. So there's always content. Just check it based on today's date. So when we're done wrapping up the session, this will I think within like 5 or 10 minutes, this is available to stream the recording. Or if you're on YouTube, if you're live, go all the way back to the beginning and you can start this. Like YouTube always lets you, if I'm live, you can just go back to the beginning and start it from the beginning versus watching it from this point forward and then having to go back. So I do that all the time with some live channels that I follow. All right, so that's what I meant by this. Yields and bonds are not behaving. We're getting some broken correlations. We're not out of the uncertainty window yet. Things are still a little bit nasty, a little bit gnarly. I still think, as I said earlier, watching to see, we have earnings coming in this week. We are going into a holiday week. Maybe there's not a big amount of disruption. And I'll say this, any positive news, offering resolution on tariffs or agreements on tariffs could result in more positive flows. Okay? For the market to behave bearish, I think we have to have earnings compression, which means forward guidance is pessimistic. Okay? We'd also have to have price action continues to claw lower. We'd have to see that the Fed is likely staying silent, right? If Trump is tweeting for the Fed to cut rates and the Fed doesn't do anything, market's not going to like it. The Fed should not do anything right now. The Fed should not do anything. If they're going to step in and save this market, it's going to be at a terrible low. We're going to be at 40% off the highs, maybe 50% off the highs, and then the Fed steps in when all the pain is in. Okay, Fed is not going to do anything other than stay the course, watch inflation data, maybe cut 25 basis points 2 or 3 times this year. That's it. So they're going to stay silent. Bond yields going higher equals higher stock market, and that's a question mark. But if bond yields are going lower, that's probably going to equal a lower stock market. That's the correlation we saw this year. All right, I said earnings compression already. That guidance, we'll see what the financials say. We'll see what all of the big banks say about this year. It's probably just a ton of uncertainty. I don't know how excited they're going to be about anything. Current companies with 90-day windows. So what else to happen? So tariff talk gets worse or more uncertain, right? U.S. versus China continues to escalate. Could still happen. Allies are more vocal on modifying trade with U.S. or seeking trade elsewhere. This is where the U.S. made probably its biggest mistake, is thinking that we can just say, look, everybody's going to be tariffed, right? And what's the world do? Well, crap, if we are going to have to pay more, do more, it's going to be harder for us to do business. Who else can we trade with, right? I mean, you're making the world pick sides. And the reality is, if all these countries are trying to do what's best for them and make the most money and have the best trade deals and have the best terms on everything, they should be able to play both sides. It's a free market, right? It should be free trade. So if we're making them choose, it just creates a lot more global friction. And if they start seeking alliances elsewhere, this is why the big thing with Canada and Europe is a concern. If they start looking elsewhere to trade, maybe Europe and China wants, or Europe and Canada want to trade more together. Maybe they start doing more reliance on China out of necessity. I have no idea, but basically the line is drawn. It's like, who's with us? Who's with the U.S.? Who's with China? I don't know if we have an answer to that. I still think the U.S. and China need each other. I still believe that, but obviously optically it looks like we can't stand each other. So it's not good for anybody if this happens. Bond yields lower should make the markets climb. Yeah, if the bond yields like persist lower, but really, realistically, I wouldn't even think about the bond yields compared to the stock market, because the only way the bond yields went lower is by the stock market going down. So right now, if bond yields go lower, that means that bond prices go up. Take away equities, like eliminate equities. Don't even think about them. They're not correlated. Bond yields should not be correlated with the equities market, but they are correlated with the bond market. So if yields go down, bonds should go up. If yields go up, bonds should go down. The stock market should not necessarily be correlated with yields, but the only way we saw the yields go down this year and get below that 4 handle was when the market was in capitulation to the downside, because bonds were down and stocks were down and everything was risk off and sentiment was terrible and the yields went lower. So point is, this is the biggest concern that I have right now with the bond market is something's not right. Like something smells fishy, something looks fishy. You can see it in the prices. You can see how fragile things are right now, and this is the uncertainty the market is trying to navigate. Okay, all right. So just keep this in mind. Let me take a screenshot of this so I can reference this later in the week. There you go. All right, we'll come back to that. Okay, everybody, I'll let you go for today. Thanks for being here for the final hour. Appreciate it if you like the video. If you're not subscribed to the channel, you can always subscribe. Free channel and trust content. I also have a Discord if you'd like to join my Discord channel. It's free. I park all my content there, from the educational services that I run to private instruction to discounts I have in the industry, from software to I'm trying to think, affiliate deals, trade deals, brokers. I mean, you can just take a look at it from my Discord channel. Go into the affiliate discounts channel. Private instruction, work with small groups. I work with private traders as well. And then everything else is for everyone to talk. Free group chat, Forex, stocks, options, futures. Anytime I post a video on YouTube, it goes. You can see the link in my Discord. Anytime I blog or do any type of analysis or post on Twitter, it pops up in there as well. And then I am live virtually every day with multiple services and YouTube, usually for at least a video, if not live sessions every single day for the final hour. So youtube.com/Chris Pulver. We are steadily climbing. Hopefully in the next couple of months, we'll sneak up here to 10,000 subscribers, which would be nice. And all the little likes and all the little thumbs up and comments do certainly help. I think my algorithm has gotten a little bit stronger organically, because I don't do anything to, I don't buy Google ads. I don't spend money on this channel. I just want to it's trust content. It's organic. It's real growth. And hopefully I'm dealing with real traders like you. Cool. All right. Good stuff. Appreciate it, everybody. Thank you and have a good day. I'll see you tomorrow. Thanks. Bye.